Let's break down how the Fed's money printer actually works. When the Federal Reserve wants to influence the economy, it creates new bank reserves electronically and uses them to buy long-term government bonds from banks. This isn't a simple transfer. These reserves didn't exist before. By adding to the bank's reserves, the Fed injects liquidity directly into the financial system and pushes bond yields down. Once the Fed buys these bonds, it removes them from the market. The immediate effect is to increase demand for government debt, driving up bond prices and pushing yields lower. Banks, now holding more reserves, look for ways to earn higher returns. With government bonds paying less, they're encouraged to lend more or invest in other assets. This is how quantitative easing sets off a chain reaction throughout the financial markets. The scale is hard to ignore. After the 2008 crisis, the Fed's balance sheet expanded from $900 billion to $4.5 trillion. In 2020, it nearly doubled again, reaching close to $9 trillion. These weren't just accounting entries. Each round of asset purchases added new money to the system, fueling asset price increases and keeping yields near historic lows. Mortgage rates tumbled, making home loans cheaper, but home prices soared. Stock markets hit record highs as investors chased returns. Meanwhile, savers saw deposit rates stuck near zero. This process doesn't just affect interest rates. Normally, bond markets provide signals about economic risk through the yield curve. When the Fed buys up long-term bonds, those signals are distorted. Investors searching for yield move into riskier assets, stocks, real estate, even speculative investments, because safe government bonds offer little return. Studies find QE forced investors into these riskier assets when government bond yields fell to near zero, a dynamic known as the portfolio rebalancing channel. This shift inflates asset prices and can create bubbles that wouldn't form under normal market conditions. Every major asset class reacts to these interventions. Companies borrow cheaply to buy back their own shares, pushing up stock prices. Real estate becomes more attractive as mortgage rates drop. Even gold can rise, not because it pays interest, but because investors worry about currency debasement